How to predict stock prices with Microsoft's AI-powered answer engine. Would it be possible to predict stock prices? Predicting stock prices is a challenging task, and there are several different approaches to doing so. Here are some common methods that traders and investors use. 1. Technical analysis. This method involves analyzing past market data, such as price and volume, to identify patterns and trends. Technical analysts use charts and indicators to help identify potential price movements. Some common technical analysis tools include 1.1 Moving averages. A moving average is the average price of a stock over a specific period. Traders use moving averages to identify trends and potential price reversals. 1.2 Relative Strength Index, RSI. The RSI measures a stock's recent price movements to determine whether it is overbought or oversold. 1.3 Bollinger Bands. Bollinger Bands are a volatility indicator that shows the upper and lower limits of a stock's expected price range. Traders use Bollinger Bands to identify potential breakouts or reversals. 2. Fundamental analysis. This method involves analyzing the financial health of a company, such as its earnings, assets, and liabilities. Investors use this information to estimate the intrinsic value of a company's stock, which they can then compare to the current market price. Some common fundamental analysis tools include 2.1 Financial statements. Investors can analyze a company's balance sheet, income statement, and cash flow statement to gain insights into its financial health and performance. 2.2 Valuation ratios. Investors can use ratios such as price to earnings, P/E, ratio, price to sales, P/S, ratio, and price to book, P/B, ratio to compare a company's stock price to its financial performance. 2.3 Economic indicators. Investors may also consider broader economic indicators, such as interest rates, inflation, and GDP growth, to understand the overall health of the economy and how it may impact a company's performance. 3. Sentiment analysis. This method involves analyzing social media and news sources to gauge public opinion about a company or the stock market as a whole. Sentiment analysis can help investors identify trends and anticipate market movements. Some common sentiment analysis tools include 3.1 News articles and press releases. Traders and investors can analyze news articles and press releases to gauge how the media is portraying a company and its performance. 3.2 Social media sentiment analysis. Traders and investors can use natural language processing, NLP, tools to analyze social media posts and identify sentiment about a company or the stock market. 4. Machine learning. This method involves using algorithms to analyze large amounts of data, including financial statements, news articles, and social media posts, to identify patterns and make predictions about future price movements. Some common machine learning tools include 4.1 Regression models. Regression models are a type of machine learning algorithm that can identify relationships between variables and make predictions based on those relationships. 4.2 Neural networks. Neural networks are a type of machine learning algorithm that can learn from past data to identify patterns and make predictions about future price movements. 4.3 Natural language processing, NLP. NLP algorithms can analyze large amounts of text data, such as news articles and social media posts, to identify sentiment and predict future market movements. It's important to note that no method is foolproof, and predicting stock prices is always a risky proposition. It's essential to do your research, manage your risks carefully, and never invest more than you can afford to lose. How to avoid bear market. A bear market is a period of declining stock prices, often accompanied by negative economic sentiment and high levels of investor pessimism. While it's impossible to completely avoid a bear market, there are several strategies that investors can use to mitigate their risk. 1. Diversification. One of the most effective ways to reduce risk in a bear market is to diversify your portfolio. Diversification involves spreading your investments across a variety of different asset classes, sectors, and geographic regions. By diversifying your portfolio, you can reduce your exposure to any single stock or sector that may be particularly vulnerable. 2. Asset allocation. Asset allocation is another key strategy for mitigating risk in a bear market. Asset allocation involves dividing your portfolio between different asset classes, such as stocks, bonds, and cash, based on your investment goals, risk tolerance, and time horizon. By allocating your assets across different types of investments, you can reduce your exposure to any single asset class that may be particularly vulnerable to a bear market. 3. Active management. Active management involves regularly monitoring and adjusting your portfolio based on changes in the market and economic conditions. In a bear market, active managers may sell off stocks that are particularly vulnerable to declining prices, such as those in sectors that are highly cyclical or dependent on consumer spending. Active managers may also increase their holdings of defensive stocks, such as utilities and consumer staples, which tend to perform well during economic downturns. 4. Avoid timing the market. Attempting to time the market is a risky strategy that can lead to poor returns. While it can be tempting to sell stocks at the first sign of trouble and wait for prices to fall further before buying back in, this strategy can be difficult to execute effectively. Instead of trying to time the market, focus on building a diversified portfolio and maintaining a long-term perspective. 5. Maintain adequate liquidity. It's important to maintain adequate liquidity in your portfolio during a bear market. This means holding enough cash or cash equivalents to cover your short-term expenses and any unexpected emergencies. By maintaining adequate liquidity, you can avoid being forced to sell stocks at a loss during a market downturn. Remember that bear markets are a normal part of the market cycle, and they can provide opportunities for long-term investors to buy high-quality stocks at discounted prices. By focusing on building a diversified portfolio and maintaining a long-term perspective, investors can weather the ups and downs of the market and achieve their long-term investment goals. What's the relation between information and stock prices? Information plays a critical role in shaping stock prices. In general, the stock market is a mechanism for incorporating information about companies and the economy into stock prices. When new information about a company or the broader economy is released, it can cause a change in investor sentiment, which can in turn impact the demand for the company's stock and ultimately the stock price. Here are a few ways that information can impact stock prices. 1. Earnings reports. One of the most important sources of information for investors is a company's earnings report. When a company releases its quarterly or annual earnings report, it provides investors with important information about the company's financial health and future prospects. If a company's earnings exceed analysts' expectations, it can lead to an increase in the stock price, while lower than expected earnings can cause the stock price to decline. 2. Economic data. Economic data, such as gross domestic product, GDP, employment numbers, and inflation data, can also impact stock prices. For example, if GDP growth is stronger than expected, it can signal that the economy is growing, which can boost investor confidence and lead to higher stock prices. Conversely, if employment numbers come in weaker than expected, it can signal that the economy is struggling, which can lead to lower stock prices. 3. Company news and developments. News and developments specific to individual companies can also impact their stock prices. For example, if a company announces a new product or partnership that is expected to drive future growth, it can lead to a rise in the stock price. On the other hand, if a company announces a significant problem, such as a major product recall or a lawsuit, it can lead to a decline in the stock price. 4. Market sentiment. Finally, information can impact stock prices through its impact on investor sentiment. For example, if there is a general sense of optimism in the market, investors may be more willing to buy stocks, which can drive up stock prices. Conversely, if there is a sense of pessimism or uncertainty, investors may be more likely to sell stocks, which can cause stock prices to decline. Overall, information is a critical driver of stock prices. As new information becomes available, it can impact investor sentiment, which in turn can impact demand for stocks and ultimately stock prices. What's the relation between information and education? Information and education are closely related, as education is the process of acquiring knowledge and skills, and information is the content that is learned and transmitted through education. Education is the formalized process of learning and teaching, whereas information is the knowledge and understanding that is transmitted through that process. Here are a few ways in which information and education are related. 1. Education is built on information. Education is built on the foundation of information. Before students can learn advanced concepts and skills, they must first acquire basic knowledge and information. For example, before a student can learn calculus, they must first have a basic understanding of algebra and geometry. 2. Information is transmitted through education. Education is the primary means by which information is transmitted from one generation to the next. Schools, universities, and other educational institutions are responsible for providing students with the information and knowledge they need to succeed in their chosen fields. 3. Access to information is important for education. Access to information is essential for effective education. Students need access to books, research materials, and other sources of information to deepen their understanding of the subjects they are studying. 4. Education helps to filter and validate information. Education can help individuals to filter and validate the information they receive. By developing critical thinking skills and learning how to evaluate sources of information, individuals can learn to distinguish between reliable and unreliable information. 5. Information is essential for lifelong learning. Finally, information is essential for lifelong learning. As the world changes and new developments emerge, individuals need to continue to acquire new information and knowledge to stay informed and adapt to new circumstances. Education provides the framework for lifelong learning and the acquisition of new information and knowledge. Overall, information and education are closely intertwined, with education serving as the means by which information is transmitted, and information serving as the foundation upon which education is built. What's the relation between economic and education? Economics and education are closely related in several ways, as education plays a significant role in economic growth and development. Here are some of the key ways in which economics and education are related. 1. Education is a driver of economic growth. Education is one of the primary drivers of economic growth, as it helps to develop a skilled and educated workforce. A well-educated workforce is essential for innovation and productivity, which are key drivers of economic growth. 2. Education can help reduce income inequality. Education can also help to reduce income inequality by providing individuals with the skills and knowledge needed to secure higher-paying jobs. This can lead to greater economic mobility and a more equal distribution of income. 3. Education contributes to human capital. Education contributes to the development of human capital, which refers to the knowledge, skills, and experience that individuals bring to the workforce. Human capital is essential for economic growth and competitiveness, as it drives innovation and productivity. 4. Education affects economic policies. Education also affects economic policies, as policymakers often look to education as a means of promoting economic growth and reducing inequality. For example, investments in education may be prioritized to improve the quality of the workforce and stimulate economic growth. 5. Economic factors impact education access. Finally, economic factors can impact access to education, as individuals from low-income households may struggle to afford the costs associated with higher education. This can lead to disparities in educational attainment and limit opportunities for economic mobility. Overall, education and economics are closely intertwined, with education playing a critical role in driving economic growth, reducing inequality, and developing human capital. What's the relation between income and education? Income and education are closely related, as education is a key determinant of an individual's earning potential. Here are some of the key ways in which income and education are related. 1. Education is linked to higher earnings. Individuals with higher levels of education generally earn higher salaries than those with lower levels of education. This is because education provides individuals with the skills and knowledge needed to succeed in the workforce, and can open up opportunities for higher-paying jobs. 2. Education can increase economic mobility. Education can also increase economic mobility, allowing individuals from lower income backgrounds to move up the income ladder. By providing individuals with the skills and knowledge needed to secure higher-paying jobs, education can help to break the cycle of poverty. Opportunities. 3. Income affects access to education. However, income can also impact access to education, as individuals from lower income households may struggle to afford the costs associated with higher education. This can limit opportunities for educational attainment and limit earning potential. 4. Education is a factor in income inequality. The relationship between education and income is also a factor in income inequality. Individuals with lower levels of education are more likely to be employed in low-paying jobs, while those with higher levels of education are more likely to be employed in higher-paying jobs. This can contribute to income disparities and perpetuate income inequality. 5. Education can impact lifetime earnings. Finally, education can have a significant impact on lifetime earnings. Individuals with higher levels of education generally earn more over the course of their lifetime than those with lower levels of education. This can impact overall economic security and financial stability. Overall, income and education are closely linked, with education playing a critical role in determining earning potential and economic mobility. However, income can also impact access to education and perpetuate income inequality. What are the main aspects that can hugely impact stock prices? There are many factors that can impact stock prices, but here are some of the main aspects that can have a significant impact on the stock market. 1. Economic data. Economic data, such as gross domestic product, GDP, employment numbers, and inflation data, can have a significant impact on stock prices. Positive economic data can signal a growing economy, which can boost investor confidence and lead to higher stock prices. Conversely, negative economic data can lead to a decline in investor confidence and lower stock prices. 2. Company earnings. The earnings of individual companies can also have a major impact on stock prices. When a company reports strong earnings, it can boost investor confidence and lead to higher stock prices. Conversely, weak earnings can cause investors to lose confidence and lead to lower stock prices. 3. Interest rates. Interest rates can also impact stock prices. When interest rates are low, it can make it easier for companies to borrow money, which can lead to increased investment and higher stock prices. Conversely, when interest rates are high, it can make borrowing more expensive and lead to lower stock prices. 4. Political and geopolitical events. Political and geopolitical events, such as elections, wars, and natural disasters, can also impact stock prices. Uncertainty around these events can cause investors to be cautious, which can lead to lower stock prices. Conversely, if events are seen as positive for the economy, such as new infrastructure spending or a reduction in trade tensions, it can boost investor confidence and lead to higher stock prices. 5. Market sentiment. Finally, market sentiment can also have a significant impact on stock prices. If investors are optimistic about the future, they may be more willing to buy stocks, which can lead to higher stock prices. Conversely, if investors are pessimistic, they may be more likely to sell stocks, which can cause stock prices to decline. Overall, many factors can impact stock prices, and it's important for investors to stay informed about economic, company-specific, and geopolitical developments that could impact their investments. So, try your AI-powered answer engine from Microsoft.